get right to it. Howard, welcome back to Milken.
Thank you, Romaine. Good to be here.
Absolutely. We were having a great conversation off stage here about the current state of markets. A lot of money has been made over the last couple of years. Some would say aided, if not abetted, by monetary policy. How does the normalization of that policy change the dynamic?
Well, the question is whether we will normalize. And by normalize, I mean, will the Fed and the Treasury take their hands off the economy and let it run itself? Or will they continue to drive it? I think I'd like to see an economy that did its thing uncontrolled by the Fed. I'd like to see what I call naturally occurring interest rates, because we all believe that the free market is the best allocator of resources. I'd like to see a free market.
What's the balance between a free market and government necessity during a pandemic, during a recession?
Well, look, the actions that the Fed and Treasury took last year had some serious possible negative consequences, the worst of which could still be a strong bout of inflation and an igniting of inflationary expectations, which would then become self-fulfilling. So that's a very negative possibility. On the other hand, you can't argue that those actions should not have been taken. If the Fed and Treasury hadn't done what they did, I think we would be in a serious global depression right now.
There are a lot of people who agree that what they did was certainly right. There's a lot of disagreement about how long they've kept some of these measures in place. Have we reckoned with the ramifications of keeping this stimulus out there too long?
Yes. Well, most people, if they were knowledgeable and if a vote were held, would prefer low interest rates to high. Business does better. People can buy stuff cheaper. Rates on mortgages go down. Politicians can spend more money. The Treasury has less trouble paying the debt service. All these people want low rates. The only thing is, it's low rates is kind of like ice cream. Is such a thing as having too much. So not too many people want to see high rates, but if we keep rates artificially low, then perhaps we overstimulate, perhaps we have inflation, perhaps the dollar weakens, perhaps the dollar loses its role as the global reserve currency. So there has to be a balance.
You've invested through quite a few market cycles,
yes,
quite a few economic cycles. Is
yes,
the one that we're in right now, does that make your job or the job you used to have more difficult or easier?
It's tough at the time. We're in an unusual circumstance. First of all, the cycle we've gone through in the last 18 months of the pandemic was not really a normal cycle. Normal cycles, in my opinion, are the result of people becoming too optimistic and overshooting intrinsic value, fair value, and then a correction toward fair value, but it carries through to underpriced, and then people get too pessimistic, and then a correction back toward fair value, but it overshoots and heads to excessive. So excess and correction is the normal source of a cycle. This cycle had nothing to do with the economy. This was like a meteor hitting the Earth from outer space. It was an exogenous event, the pandemic, and then the government Fed policies undertaken to correct it. So I saw a pandemic, an epidemiologist from Harvard at the very beginning of the pandemic, and he said we have three things. We have facts, analogies to prior experience, and supposition. But in the case of the pandemic, there are no facts, there are no prior experiences. We have only supposition. And I think that's where we have been. So that has made life tough.
Right. Well, then, and as an investor, how do you determine intrinsic value? How do you determine value at all?
Well, you try to figure out what the cash flows will be. You discount those back to the present at a fair discount rate. You apply windage for uncertainty, et cetera. That's what you normally do. normally do. But of course, first of all, we have the lowest lowest interest rates in history. Which, if something grows faster than the discount rate, then in theory it's worth infinity. So it's hard to operate in a world where things are worth infinity. And by the way, there are people who are willing to pay infinity for them.
We've seen that.
Makes it hard on a value investor. And then, of course, since it's not a normally occurring economic cycle, it's harder to get your hands on it. Normally, when we're at the beginning of an economic upcycle and we're only a year in, you're usually pretty low in terms of the market. Now we have a market which is high, and the economy is getting going. So, I say in the first year of the recovery is getting going. But you could say, well, the bad news is that the economy hasn't done much and stocks are highly valued already. Or you could say the good news is that stocks are highly valued, but the economic recovery lies ahead.
Yeah.
And investing is full of on the one hand and on the other hand, and I think this is a great example.
But those valuations have not only caused people to question the current state of capital markets, but to seek out maybe risky alternative things that maybe are a little bit harder to pin value on. Cryptocurrencies, for example, something that you yourself said at one point was basically worthless.
Yes.
You still don't feel that way.
Well, I put out a memo in January called Something of Value, in which I said I thought that my reaction to Bitcoin in 2017, which was the year that it exploded from 1,000 to 20,000, that my reaction was a knee-jerk, skeptical reaction to something new because of its newness. My son and I lived together during the pandemic, and he gave me a lecture every day on the fact that I had opined about Bitcoin without knowing what I was talking about, which is certainly true. We have the lowest prospective returns in history, and my typical client, a pension fund, an endowment, for example, needs about 7% a year return to make the math work. And most people have accepted that you can't make 7% today safely and dependably, and certainly not from stocks and bonds, developed world stocks and bonds.
Right.
So that means you have to go push out the risk curve and go further afield,
right,
into new things or odd things or something like that. You have to take, you have to go into, let's say, maybe private equity and take on the risk of being levered. Or you have to invest in assets which are illiquid in nature. So,
What about real estate?
Real estate's another example. I mean, now, investing is always a place where the things that everybody likes and feels good about are highly priced relative to the things that people have trouble with. So, everybody says, logistics and data centers. Great. Okay. I don't think you can buy them cheap. It's counterintuitive that everybody could agree that an asset is great, but it's a bargain. On the other hand, everybody says, well, brick and mortar retail, I don't know about that, and office buildings in coastal cities, I don't know about that. So if people are skeptical, then that creates the possibility that these things can be bought cheap. But still, you need subject matter expertise. One of the great messages of that memo about my time with my son was that if you can't look at something superficially from the outside, from a high level, and opine on its fairness. He says, the S&P at that time was selling at around 24 times coming earnings, and historically, one would look at that and say, well, that the post-war average is 16, 24, 50% higher than that. That's an extremely high valuation. But what he says is, number one, you have to be conscious of the fact that the composition of the S&P has changed. It's now 27% information technology, and in general technology, much more than 27. That's something new.
Right.
And in order to be able to look at it, you have to understand the tech stocks, and you have to conclude that they're overvalued. And to do that, you need expertise.
Has risk become too concentrated?
I don't think it's become too concentrated. I think it's become too warmly embraced. As I say, people, what people are saying is, if I can't get the return I need safely, I'm going to try to get it unsafely. Well, that introduces some concerns for the whole investment environment.
When you have a market that is distorted, say overheated,
Yes.
like a lot of people would say the current markets are now, how would your firm, how would Oaktree either position themselves or exploit that situation or protect themselves?
People in the media have,
Like me.
like you.
Yeah.
I wasn't going to
Okay,
say that.
that's fine.
But people in the media try to get you to say buy or sell, in or out, risk on, risk off. And I've stopped doing that in the last 5 or so years. And the way I think about things now is, what is your normal position in terms of risk, given your age, resources, needs, dependence, plans, intestinal fortitude, etc. What is the right risk posture for you? Where should we be today relative to that normal risk posture? And I would say for Oaktree, we're at normal today. I don't think it's time to be much more aggressive than normal, but I have trouble going strongly on the defensive when I think the economic outlook is still good. So I would say normal.
How much does duration factor in to your strategy?
Well, the duration is a consideration for the straight fixed income world, because the volatility of a security, the responsiveness of a security to changes in interest rates is a function of its duration. But we don't care about that, because we're not classical bond investors.
When you look at, I guess, the overall economic picture, some of the improvements that have been made in our economy here in the U.S. as well as globally, and you go back 40, 50 years ago when you were starting, what are the improvements that you've seen?
Well, clearly the events of last year, to the extent that they're indicative, showed that we've learned how to fight recessions, and we used to have recessions that really kind of got out of control and went on for a long time. In the global financial crisis of '08, post the Lehman bankruptcy, the government figured out some things, ranging from quantitative easing to guaranteeing commercial paper, et cetera. And those things worked. They took them some months to do, but they worked. They applied those lessons last year in the pandemic in days or weeks, and they worked enormously. So that's an example. And of course, on the other hand, one of the great trends of the last 50 years is that most markets have become more efficient. Buffett used to talk about buying dollars for 50 cents routinely. It's hard to do when there are a lot of other intelligent people looking for the same 50-cent dollars. And they all have good eyesight, and they're all highly motivated, which is where we are today. So it's gotten harder to beat most markets.
Is that efficiency? Is that good for the market overall? I know for investors that's not always good.
Well, in theory, efficiency is good for the market, because it helps companies raise capital at a fair cost, and it helps people invest at a fair return. But of course, people in my position are not looking for a fair return. We're looking for a return that's more than fair. What the academic would call an excess return. That's why we exist. If you're willing to take an average deal, you don't need us.
No.
Investing, it's really easy to be average, and it's quite hard to be above average, and it's gotten harder. And the measure of superiority has shrunk over time. That's efficiency.
Right, and where you benefited and where a lot of investors of your generation benefited was there seemed to be a little bit more randomness to the market. There seemed to be a little bit more asymmetry in the market that can be exploited. If we're at a stage now where everyone knows everything.
Well, I mean, when the markets become more efficient, it becomes harder to outperform.
Mm-hmm.
And that's where we are. You know, I look at high yield bonds. I was in with Mike at the beginning of the high yield bond world. I met Michael in November of 1978. The high yield bond world started in 77 or 78. And I could put together portfolios that would have higher returns with lower risk.
Mm-hmm.
Then the market got a little more efficient. And then you had, if you wanted, it was a great achievement to have a portfolio with a higher return with the same risk.
Mm-hmm.
When the market becomes more efficient, portfolios that have higher returns generally have higher risks. So the world becomes less attractive from the point of view of a bargain hunter.
Mm-hmm.
Today, or in recent days, I would say that the best inefficiencies have come cyclically, not secularly, but cyclically. And you know, there have been 3, 4, 5, 6 occasions in the last 25 years when at least the potential was there to add value by timing the market right. Mm-hmm. and knowing when we were at extremes.
With regards to the structure of investment firms and asset management firms, how important today is scale, size?
On the one hand, having a bigger asset total permits you to have more staff, in theory, more expertise. On the other hand, it reduces your flexibility and your selectivity. And you know, the truth about the investment business is that good performance brings more money. At some point, more money brings bad performance. So the goal is to arrest that process before you have too much money. Now, there's no way to tell in advance where's too much money. You know, if you and I worked for Firestone, mm-hmm. and we developed a new tire and we said, well, how far will that run, Romaine? You'd say, well, let's put it on a car and find out, and you run it until it blows up. Mm-hmm. We don't have that luxury. We can't expand our assets until our performance blows up. Mm-hmm. So by definition, we have to stop this side of the wall, mm-hmm. which means we never really find out where the wall is. But I think that limiting your assets is important, and mm-hmm. I think about our industry as ranging from artisans to factories. The artisans have less assets, mm-hmm. but you know, do a more labor-intensive job, and the ones with skill have better performance. The factories may competently manage vast sums mm-hmm. at low cost, but are unlikely to have great performance.
But we've seen consolidation in this industry, yeah. particularly among some of the artisans and the factories.
Yes.
You yourself partnered with Brookfield,
yes.
Oaktree. What was the impetus behind that? Why?
What
was the reason behind the partnership with Brookfield?
Well, mainly, I mean, Brookfield initiated it because they wanted to be in the credit business. Mm-hmm. And if you look at their asset classes, which are private equity, real estate, renewable energy, they wanted to be in credit, and they figured it would take them a long time to build a credit operation, and it may not end up as what Oaktree is. So why not buy Oaktree? Mm-hmm. And so they bought 60%. The public owned 50%. They bought that out. They bought 10 from us, and that settled in the fall of 19. Mm-hmm. And then and they'll, you know, we have the option to put our remaining 40% to them over time.
And then they retained your expertise, though.
And they retained our expertise.
And that seemed like a testament to how hard it is to build that type of business.
Yeah, I think so. I mean, in this case, they concluded that it was better to buy it than make it, and I think that made some sense.
I want to pivot here, Howard, to some of the discussions that we've been having in the pandemic about diversity and inclusion.
Yeah.
You, Oaktree, Ares, Apollo,
Yeah.
recently started an initiative, $90 million being pledged to HBCUs, but it's specifically targeted at trying to find people to move into the alternative investment world.
Right, right.
Why?
Well, look, first of all, organizations like Oaktree and the ones you name, I think have been concerned with diversity for years, doing something about it for maybe years. But, for some reason, the events of 2020 got everybody to kind of turn up the heat. Maybe it was being home and watching more TV. Maybe it was the starkness of the Floyd murder. But that struck a responsive chord that hadn't really been struck before. We all knew that that representation of women and underrepresented folks was disappointingly low, but kind of for some reason 2020 is the year people decide to do something about it. And so Ares, Apollo, and we got together and we formed this thing called Alt Finance. And by the way, if you look at the numbers of the investing industry overall, I think they're much better than the numbers for the alternative investment world.
Oh, yeah. But you walk onto an equity division, it's a lot of diverse faces,
right.
Fixed income.
Exactly. So, it takes time for the people who don't transition as easily to find the new thing. Alternative investing is a pretty new thing. I don't think the word existed 20 years ago. We just got, we and Apollo and KKR and Ares and Blackstone got lucky because the world turned out to need the solutions that we offer. And but as I say, it's a rather new development, and people haven't gotten to us yet, and we're highly selective. And the challenges of, well, everybody I know who's done it is a man or is a white man. They make life tough, and you have to break through that. So we're trying to break through that. We're trying to raise awareness of the alternative investment world on the campuses of historically black colleges and universities, and then provide curriculum. And we're developing a curriculum in partnership with Wharton, and provide fellowship money so that people can afford to go to school and deal with emergencies that arise and provide internships. So we're looking at a 360 package that should, over time, raise the representation of the underrepresented in the alternatives industry. That's our goal. And of course, in so doing, attract desirable staff members ourselves.
Of course. And of course, this comes at a time when alternative investing isn't the niche that it once was. I mean, everyone seems to be hanging out in an alternative investment banner of some sort or another.
Well, it's not the niche it used to be in terms of, if you went back 40 years ago, you would say, well, I have 60% in U.S. stocks, 32% in U.S. bonds, 3% in emerging markets, 1% in private equity, 1% in an index fund, and 1% in hedge funds. That was, those things were just kind of exotica that were in there for spice. If you were in the 90s and the S&P was appreciating at 20% a year, as it did, you didn't need that other stuff. Today, you need it. So, today, that stuff is not considered exotica. It's mainstream. And today, there are trillions in those fields. So, on the one hand, it's gotten harder to steal stuff. It's gotten harder to find real bargains, glaring bargains. On the other hand, it's a much bigger industry. We can hire and employ many, many more people, and we want to increase the representativeness of that population. And I think that Ares and Apollo and Oaktree went into alt finance because they were unsatisfied with this underrepresentative workforce.
Do you worry about, I guess, some of the commoditization in this area of investment, and even some of the passive investment instruments that are being offered now in the alternative space?
Well, look, you never want to see commoditization, and you mentioned real estate before. If you're a real estate investor, you can do X, Y, Z. But if 5 other firms open and they're each capitalized at $100 billion, your life gets harder because they have money to put to work. If they put that money to work, they could raise another fund and then get some more management fees, and they're eager to put the money to work. So if there's a lot of cash on the sidelines and a lot of eagerness, life becomes harder for you. And that's just the facts of life. And that's this process that I call efficientization. And our markets have become more efficient, which mostly means higher priced. So that's undesirable, but that's the way the world goes.
A few more questions here. Distressed investing. What does distressed investing even mean right now in this day and age?
Well, strictly speaking, nothing's distressed. Or the couple of industries that have some distress have some real fundamental problems. You know, the goal in distress investing, as in all forms of investing, is to buy things for less than they're worth because they're underappreciated, or unknown, or not understood. But today, fewer things satisfy those criteria, and there isn't any distress to speak of. The default rate on securities is incredibly low. We didn't have much of a, we were supposed to, the default rate on high yield bonds, for example, was projected to get up to 15% in the pandemic, and I don't think it ever got up to half that because of the government and Fed rescue actions. And we were primed for a real panic opportunity. We raised the biggest distress fund in history, $15 billion, ready to go, and the opportunities didn't materialize. Now, we have found good opportunities to lend people money that they needed and couldn't get from the public markets, and maybe they needed it in a hurry. Maybe there was some hair on on the proposition. So we were able to put together a portfolio that we think will return, I would say, in the mid-teens, but we didn't get the returns of 30 and 40 and 50% that we got in some past crises.
We've seen a lot of appetite for subordinated debt. It seems pretty insatiable.
Yes.
The amount of money that Ares and a few others have been able to raise for some of these junior funds. Is this a once-in-a-lifetime opportunity?
Well, I don't know. It's hard to say once in a lifetime because once-in-a-lifetime opportunities tend to come along every few years. But I think it's a once-in-a-lifetime opportunity for companies to borrow money, which means that it's maybe a once-in-a-lifetime opportunity to make bad lending decisions. I mean, again, it all comes down to you get great opportunities when you do the things that nobody else is willing to do. But when you do things that everybody else is eager to do, it's hard to imagine you're going to score any great bargains. And that's where we are today. So I think on the one hand, you want to invest because of the strength of the economy and you don't want to be left behind, and FOMO is a concern. But on the other hand, it is a time to be careful because the worst of loans are made in the best of times.
Yeah. Has Howard Marks ever felt FOMO?
Sure, I'm human, and I think the mistakes that we've made were mistakes of omission because in some cases we were too conservative.
Howard, this is a pleasure.
Romaine, pleasure's mine. Thanks for your questions.
Thank you. Our thanks there to Howard Marks, of course.